new person, what would be the key thing that they should focus in on? Let's say they're only been trading for like 2 years or less.
I would say when they buy something, at the same time buy an equal amount of the S&P 500 and track those two meticulously. It'll smooth your equity until you become a trader where you know that your system has a positive expectancy. Buy half of the S&P and half of the individual name that you're buying. As you go along, just reduce the amount of the S&P and this gets to cash drag a lot too. When you're first starting coming off of a low, off of a correction, getting back into the market, if how those indexes can shoot up, Mike, at least if you're in the S&P 500, you're gaining some of that. And so at the end of the year, you're not massively behind the S&P 500. And a lot of this is the fact that we run money, and people are always asking us what we're doing versus the S&P 500. So we got to look for every way to eliminate things that are going to drag on our returns. But if you're just starting out, buy an equal amount of each. See how much money you're making in that S&P buy and how much money you're making on that individual stock. It'll curtail the risk on the stock that you're buying, and it'll give you good feedback for how it's doing versus the S&P 500, which you bought at the same time.
Dude, I love that. That is really good advice. I've never heard anyone give that advice before, and it makes so much sense. And another way along those lines that people can do is look at that RS line from where they bought it to where it is now. So let's say they bought a stock a month ago and they didn't do what you were saying yet, but now they're going to start. Look at that RS line, because that RS line is just relative to the S&P. If it's up higher than where you bought it on the day you bought it, then it's outperforming. If it's under, that's giving you that same type of feedback. So I think that's genius.
I always say, and this might be me just repeating something that I heard you say in one of the seminars, that no chart is complete without a relative strength line on it, because a chart can look fantastic. And then you look at the relative strength line, and all it's doing is moving in sync with the S&P 500. So did you really gain anything? You could have bought the S&P 500 and not had any single stock risk.